Good morning, members. My name is Jennifer Montsinger, and I am your Executive Vice President. Thank you so much for joining us this morning. You know, this industry is so vital to our community, and we are committed to making sure that you have updated information so that you can have some certainty in some uncertain times. So although most local governments have closed their offices, and they are not having public meetings and they are not open to the public, they are still processing your permit applications and they are still conducting inspections. Looks like all that advocacy work that we have been doing over the last 10 years, pushing the jurisdictions to use technology, is paying off. In the city of Tampa, the process is 100% electronic, so you should not be witnessing any level of service interruption. And in Pasco and Hillsborough, where it's not 100% electronic, they have still set up places on first floors to receive your applications, and they are set up to review those applications electronically. Now, I'm going to ask, if at all possible, please try to submit your permit applications electronically. If you have any questions about the processes, we're keeping our website updated on COVID-19 related items at our homepage, tvba.net. So please check that often for updated information. Also, remember, these folks are coming in and processing your applications. So please be respectful of them and give them your appreciation. I know I'm extremely grateful to them. So if you've ever attended one of our economic forecasts, then you're extremely familiar with this format today. The only difference is I'm not going to be serving cocktails, maybe later. So we have with us this morning Robert Dietz. He is NAHB's chief economist. We have Christine Smale with Myers Research and Tony Polito with Metro Study. We are so grateful to have them this morning so that they can give you their insights on what's going on and help keep you prepared. Robert, what do you see out there for us?
Yeah, thank you, Jennifer. I think I'm going to give you the national and call up my slides here. Some of the high-level thoughts. You know, the data over the last few days have been sobering. So the slides I'm going to walk you through will take you through some of that kind of high-level materials, and I know the other presenters are going to look at local conditions. So, you know, I think the way to think about things right now, it's clearly hard to model the effects of a virus outbreak. This is a kind of maybe a once in a century type event. As you all know, there's no vaccine, they easily spread, and as we've learned that the severity rate can be quite high, which can have an impact on local health infrastructure. So the economic and financial impacts are going to be quite large. We're seeing that in the stock markets right now with declines up to 30%. It's really difficult to forecast earnings, and markets hate uncertainty, and that's kind of what you're seeing in the stock markets right now. We were looking a couple of weeks ago on supply chain impacts. About 30% of builders are saying they're seeing some disruptions. Those are from trade effects, things like lighting fixtures, plumbing fixtures, but those concerns don't seem to be rising particularly quickly. What we're looking forward to is declining consumer confidence. That is almost certainly going to happen, and that will have an impact on purchases of larger items. And then I'll provide you some details on kind of the economic outlook and what we think will be a fairly sharp bounce back once we get through this stage. So I think a good way of thinking about this is kind of the format that I've adopted, is 2-month considerations, 2-quarter considerations, and 2-year considerations. So over the next 2 months, obviously, we're going to have a lot of closures. We've got people working more at home. 2/3 of the U.S. economy is a consumption-based economy. 40% of that is goods. We're clearly seeing a lot more deliveries of goods. But the other 60%, about a half of that, is social-based services. In other words, restaurants, travel, tourism. And that is taking an enormous hit right now. As I mentioned before, really the limits on how we deal with this in terms of how quickly it can be dealt with is really due to limits on hospitals. So there's a lot of discussion clearly about flattening the curve and making sure the number of cases doesn't overwhelm local public health infrastructure. So the question really is for the US, and in terms of trying to do an economic forecast right now, are we going to look more like South Korea? Or are we going to look more like Italy? Italy clearly has higher growth rates. South Korea looks like it beat off this kind of impact over about a 6 to 8 week period. But in the meantime, the economic damage is going to be really quite large, particularly for highly indebted companies. And something, and this is, Jennifer mentioned this, this is really where your membership pays in terms of being a member of a builders association. We're really going to have to focus in every single market on making sure the home building and remodeling are deemed as essential services in those markets where a lockdown occurs. That will include things like grocery stores and fuel, but making sure the housing stock is in good shape and the importance of housing overall is really going to be an important advocacy task over the next couple of months. All right, so 2 quarters. We think virus cases in the US will subside by the time we get through 2 quarters. Once we get to a point where we feel like those cases have peaked, financial markets will stabilize. But in the meantime, we're going to have a terrible second quarter, likely a decline in the third quarter, and then a rebound in GDP growth in the fourth quarter. In the meantime, we can expect fiscal policy to be really aggressive. They're going as far as talking about sending checks to individual households to make sure people can pay the rent, pay their power bills. I think that discussion will continue. We're probably looking at $1 trillion, maybe even $2 trillion of fiscal policy. In the meantime, the Federal Reserve is playing the role that it usually does, making sure that liquidity exists. And they've restarted quantitative easing to kind of buy treasury bonds and, importantly, mortgage-backed securities to make sure that mortgage interest rates don't rise. So we're expecting a rebound in the fall. We're just going to have to be patient. And then if we think about the 2-year considerations, eventually we're going to get a vaccine. The promise is 12 to 18 months. So if this is seasonal, a vaccine will certainly help. I think it's going to take about 2 years for the interest rate cycle to normalize. And then, we're listing all these bad effects. Let's focus on a potential good effect, particularly for housing. We could see a baby boom here. People are living at home a lot. We've been waiting for this. Fertility rates among young women have been fairly low for the last 4 or 5 years. Maybe this is where we see Gen Alpha, which is the generation after Gen Z, really begin to take off. So I put some question marks there. That's speculative, but I always like to look for some good news. The other concerning thing is checkerboard pauses. This is the idea of maybe we have periods of time where we have, social distancing for a period of time, and then it's unlocked, and then it comes back again. That could particularly be true if we see that this is seasonal. And then changes for how we live. Maybe all this teleworking is going to be positive or permanent, and that could really kind of, again, offer a opportunity for remodelers and new home design. So let me kind of just walk you through some of the macro data. This is all preliminary because we're getting new data going forward, but we're looking at a particularly rough second quarter, probably something in the neighborhood of a 10% decline. This is a massive drop. You can see it after the red line there at the end of this slide. We're also seeing a weak third quarter. So, national economy right now, the probability of a recession, according to this forecast, is virtually guaranteed. But we do think we're in store for a rebound in the fourth quarter because this isn't a financial-led shock. This is just a temporary pause in the economy, and so there will be that pent-up demand going forward. In the meantime, the Fed funds rate, virtually zero at this point. The 10-year Treasury this morning, I think it's right around 1.2%, maybe a little under that. The Fed is doing everything it can to make sure the 10-year Treasury doesn't go up. And the 30-year fixed rate mortgage, it varies depending on what part of the country you're in, but we're looking at rates below a 3.5% rate, and I do think that is going to be the case for a while. Now the Fed has basically stabilized the credit markets and the financial markets. The jobs numbers. Here's where the news really is going to be bad. When we see the layoff numbers next week, we could see layoffs nationwide totaling more than 1 million. And our estimates right now are based off of almost 5.5 million job losses, essentially over the next couple of months. So you can see that red line going through this graph. That's the unemployment rate. You can see it's spiking there in 2020. We're probably looking, if we're correct, about somewhere between 5 and 6 million job losses, the unemployment rate rising just below 7%. And to put this into scale, keep in mind, there are about 15 million people that work in the restaurant industry. And that is really where you're seeing a lot of layoffs. Some of those workers are being picked up in other sectors like grocery stores and travel. But the job market is going to be ugly over the next 2 months. Again, that's why I use that 2-month, 2-quarter, and 2-year approach. For housing nationwide, and again, this is very preliminary, you can see the upward path that we had been on. We had been underbuilding during this cycle, and now we're set for a shock. It's going to vary market to market, but I think nationwide we're likely to see single family starts down somewhere between 5 and 10%. Our model right now is saying 7% in 2020, with sales performing the same. But we do think it will bounce back. And this is important as leaders in the housing industry. We do think housing is going to help lead the economy out of this downturn. This is where the pent-up energy in the system is right now. And with low interest rates, and once people get their confidence back and we get past this period, housing really is set to grow and lead the economy. So where is builder confidence? Well, unfortunately, this is a backward-looking measure. This is our monthly builder confidence measure. It's at a level of 72 right now. I would not be surprised when we do the April estimates, which will be in a few weeks, that this number drops below 50. That's what it would have done in a recession. And given some of the other business sentiment indicators we see at the national level, that's the expectation. So I just wanted to end with, when we're modeling the national economy, unfortunately, we have to model how viruses behave. This is something I never thought that we'd be in this kind of environment, but it's been a useful exercise. I put up 2 curves here. You got one dashed red, one in blue. This is kind of a measure of, for example, a hypothetical virus spread. And we're on the exponential growth curve right now. So we're going to see some scary numbers, small compared to the flu, but some scary numbers over the next few weeks. And I think what's important to keep in mind is the difference between an unchecked exponential growth, which is the dashed red line, and what's called a logistic curve, which is exponential and then goes logarithmic, which is the blue curve. And most virus models suggest over time that you get a slowing. Now, why is this important? It means that the news is going to be particularly bad over the next couple of weeks, but this will end and it will slow. And most virus models or any other kind of spread models usually use logistics. So just kind of keep that in mind as a kind of a mental tool to kind of think about, will we get through this at the end? The other thing is we're kind of looking for a little bit of good news, and I thought this was interesting, so I'm just sharing it. There's some evidence to suggest this is seasonal. We put some circles here. This is a map from a data point or from a paper that came out recently, looking at where the big outbreaks are globally. The black circles are those areas, and they're all kind of in the same temperature range, which sort of suggests that we haven't seen these big breakouts in India or Vietnam, places that had China links. And so that might suggest there's some seasonality to it. Now, I'm not saying that's a cure-all. We know people can still get the flu in July. But what it means is we're likely to see a few weeks of bad news and then things begin to taper off. And that does then have an economic impact on consumer confidence. So just kind of wrapping up, we're currently modeling our macro job GDP numbers based on an 8-week pause for the economy, and that is damaging. Currently, there's a high level of fear. You certainly see that in the stock markets, but I think it's important to emphasize we're going to get through this. Maybe we'll see a baby boom. Keep in mind that kind of thinking of 2-month, 2-quarter, or 2-year targets in terms of making your business strategies. Be prepared for a lot of new policy work, particularly connected to loans and labor. And we're going to see weak mid-year economic performance, but I do believe we're going to see a bounce back in the economy likely at the end of the year, and housing should lead the way. So thank you for being members. Membership is particularly important right now. I think we're a sector that's going to shine, and thank you very much.
Great. So this is Christine Smale from Myers Research, and I am joined today with Tony Toledo. I am the Senior Vice President here in Florida, and for those of you who don't know Tony is the Regional Director for Metro City covering the Tampa and Central Florida region, but most of you do know him. So with that, I will turn it over to Tony.
Okay, right now, Christine, I don't see the slideshow, so I don't know if they're sharing the screen with you or not.
Oh, they probably have to give me control.
Yeah, Lauren, if you could pass control to Christine, and now you're on video.
Oh, okay. Well, there's my office.
Christine, what you want to do is you want to share your screen.
Down in the bottom center of the toolbar, there's a button that says share. It's in green.
Okay. Sorry about that. Okay, let's start. Can everyone see this now?
Yes,
Yes,
you're live.
All right, great. Thank you. So I introduced myself and Tony, and you've got to love changing everything over to technology based. So I apologize for that, but let's get rolling with Tony.
We're going to start with where we finished our winter frame briefing. So for our clients, we had everyone in a big room. We talked about what was happening in the market. We'll go over a little bit of that today, is kind of where we were before where we're going. But I ended with this. There were a couple of analysts with Goldman Sachs saying the economy is nearly recession-proof. And of course, the last word I said was they also said the same thing in 2005. So that said, it certainly looks like we will see a recession. In fact, it may not be defined yet by the Economic Bureau that states a recession is here, but certainly with the job losses and everything else we've experienced in the past couple of weeks, the recession has already begun. With that, Christine.
So when we give our forecast, we always mention, things look good, things look great, the economy's doing well, but beware of that potential black swan. And I think right now with COVID-19, that black swan has really appeared. So we're going to go through today, where were we before that black swan came out, the Tampa Bay strengths, and also the risks in Tampa Bay. We'll go through a few different scenarios and then wrap up with some strategies and conclusions to help you manage your business going forward. Tony?
So arguably the entire I-4 corridor, of which Tampa is part of it, was one of the strongest areas in the nation for housing as we started this calendar year. The survey markets that we do, we look at a couple key elements. One of it is the total housing inventory, and you can see that Tampa was the lowest in the nation in terms of months of supply of inventory. So that's under construction, it's model homes, it's finished vacant. So if we see any sort of slowdown in cycle time or completions, we're still going to be much better than the rest of the nation. So the health and the efficiency of our market was pretty strong over the past few months. Obviously, it's going to change and already has changed going forward. One other piece of that, go ahead, Christine, is the finished vacant number. And Sarasota was the lowest in the nation. Tampa was the second lowest. So we didn't have a lot of overheated spec inventory sitting there. We weren't over aggressive in our movement going forward. And you can see in total, go ahead and hit the slide, it was essentially just slightly over 30 days. It was a 33-day supply of finished vacant inventory sitting there. We surveyed 16 of the top 20 builders in the market this past week. We actually had 2 of them respond that sales were okay, but they sold more specs this week. So I don't know if that's the psychology of wanting to get into a finished home now, not knowing the unknown of how long it'll take to finish, or if they want to get out of the apartment and kind of higher density into a single-family home in these times. But we've seen those quick move inventory numbers drop. And this we kind of look at a survey, and we do it through Builder Exchange, BDX, and we look at the number of units that are listed as quick move-in, available immediately, move-in ready, however the builder quantifies it on their website, and we mine these from the builder websites. And you can see from January now, our finished vacant or ready to move in number of units have dropped by 20%. So that's actually a positive sign that we're still seeing people buying, and right now, the interest in the finished vacant or the quick move-in home is pretty high. Go ahead and hit the next slide. So where are our buyers coming from? So this will be one of the challenges. One of the things we've heard from is particularly out-of-state buyers are postponing their color selection. So that could obviously impact the front end of the process. So if you look at Pasco County, this is tax data. people that moved there in 2018. It's the best set of data we have from the IRS. And you can see there was 11,342 exemptions or people on tax returns that moved into Pasco County in that 12-month period. Now, this is not a net number. This is strictly people moving in as opposed to those that are leaving. But you could see that's, 4,000 units of demand that is coming from out of state into Pasco County. What was interesting to me is the household income levels are about the same, whether you're moving in state or out of state. That's a little bit different when you look at Hillsborough County. So Hillsborough, the out-of-state people coming have substantially more income. So that could put a little bit of a hurt more on Hillsborough County and activity levels. And we had almost 32,000 people move from out-of-state into the Hillsborough County market in 2018. And certainly we're going to expect the same thing for 2019. And we were starting to, still seeing that trend through the first couple of months here. So out-of-state buyers have been a big piece of our housing demand. It will be interesting to see how that is affected as we go forward. We certainly know that, color selections and travel are down, particularly for those that are out of state. And we'll see what that effect may be. Go ahead and hit the next slide. So our starts numbers, we were actually trending up at almost double-digit levels. So once again, that I-4 corridor was as hot, arguably, as almost any market in the country. Our closing numbers were up 12%, and it's all based on the job growth. So go ahead and click. Our job numbers have been really, really good. And you could see in the sales per community, we started off 2020 really strongly. In fact, we had several builders say there were weeks in late January, early February that were amongst their best ever for their Tampa divisions. So even though the national numbers were moving up, the Tampa Bay sales per community rate has been substantially higher than the national average for the past year or so. And you could see how strong it had been. We had really hit a good, strong peak in January and February before we got into the real effect of COVID-19. So when you look at resale numbers, Naples has had arguably the highest in the country. It's a very seasonal market. It's not even a second home market. It's a third and fourth home market. But they're carrying 7 months worth of resale inventory. The Miami, Fort Lauderdale, West Palm Beach, Super CBSA, they had a pretty high level too at 5.7. When you look at the rest of the state, however, Sarasota, which is a little more retiree, was a little bit higher. Same with Fort Myers. It got better in Jacksonville, better in Orlando. And Tampa, equal to Orlando, but arguably one of the lowest months of supply of resales in the entire state of Florida. So once again, we're seeing vibrant demand in the marketplace. Why is this important? Because once we get through this, we believe that it will return again at these kind of levels. So when we look at the strengths of Tampa, one of the ones, this is just a global strength, is our savings rate is much higher today than where we were in 2005. So people a little bit better off to weather kind of the short-term storm that we anticipate. Certainly there's going to be a lot of federal aid that's out there, but our savings rate today was higher. So that's one of those core strengths that helps us when we kind of look at what shape, and Christine will get into it later, what kind of shape this recession will take. One of the other things Tampa had was you look throughout the state, the high-income jobs. Tampa actually had a higher percent than any of the other big CBSAs in the state of Florida. So we weren't just creating jobs, we were creating really good jobs. In fact, once a year they do a restatement of the numbers, and that just came out last week. Our final January 12-month rolling number was 36,400 new jobs in the Tampa CBSA, which was just slightly behind Orlando. So we were a very strong number 2 statewide. And in terms of percentage, we were looking at 3.1% job growth. So, and the unemployment rate also right at that number as well. So our unemployment number below the national average, we've been that way for the last 5 full years. Our job growth has been good. So we anticipate as we recover, we will bounce back. Go ahead and go through the next one. So our population forecasts are still very strong. We're still seeing good growth into the market, at least we had been through the early part of March. And we anticipate when we get through this, we already alluded to the potential baby boom that's out there, but the true baby boomers, we're only in year 2 of those folks turning 65. So there's another 9 years of the original baby boom that will be reaching age 65 in this coming decade in front of us. So we anticipate still robust demand from active adults as we move forward. And then when you also move forward, the millennials are really gaining strength as well and really entering those key home buying demographics. So we anticipate, kind of that dual threat of millennials who may now have their own children because of this potential second baby boom that's out there. but also those true 1946 to 1964 baby boomers getting to retirement age and still coming to Florida. So the risks that are out there, basically it's job losses. And if you think about it, when people ask me to describe Tampa, Tampa has a little bit of everything you associate with Florida. We have beaches, maybe not as famous as South Beach or Daytona Beach. We have theme parks, but not as many as Orlando. We have cruises, but not as many as Port Everglades or Port of Miami. We've got condos, but not like they have in the Gold Coast. We've got golf courses, but not many as per capita as Naples does. So we've got a little bit of everything that Florida is known for. That includes hospitality. So hospitality and retail trade are likely to be the two biggest sectors of the economy that are going to be impacted during the summer months and the effect of COVID-19. So we wanted to quantify that for you. So right now there's almost 160,000 people working in retail in the Tampa Bay market. If we lose 20% of those jobs, that's 31,560 job losses. That would take that unemployment rate around 3 up to just over 5%. That would be a big effect, but not nearly as big as the leisure and hospitality. This came from the U.S. Travel Association, and they're projecting that half of the current jobs will be lost nationwide. So they're talking about 4.6 million jobs nationwide in the hospitality sector that could be lost. That alone would push the unemployment rate nationwide up by almost 3%. Well, here in Tampa, 50% of our hospitality jobs, we have 161,000 in the hospitality sector, so it's just about on par with retail, just slightly above it. We could be looking at 80,550 job losses from that sector. That alone, with no other effect in any other sector, would kick our unemployment rate up over 8%. So when you stack those two together, just retail job losses and hospitality job losses, we go from 3% to up to 10.3%. Now, there is this hidden good news in that number. In 2009, our local unemployment rate was 12.6%. So it would still potentially be beneath what we saw in 2009. Better than that, it's expected to be a much shorter recovery than what we went through in 2009, where arguably it took us 3 years beyond that to kind of get back to a normal job scenario and a normal demand for housing. We don't anticipate that with this current environment. So once again, we alluded to the original baby boomers. Mature couples today are about 18% of our buying profile. What's interesting is mature singles are almost on par with them. So we're seeing a lot more single buyer households, particularly amongst the mature group that's out there. So that's 35% of our sales. And as I alluded to earlier, we're only in year 2 of those baby boomers turning 65. So what defined the baby boom was 11 straight years where the birth rate was over 4 million. Now we're into, that second year of that, and we'll have another 9+ years of demand from that sector. So as we recover, this will help kind of speed up the curve of recovery. What is hindering us, though, is wages. And the blue line is the national average. The red line is kind of the Tampa Bay numbers that are out there. So our wages are lower than the national average, and that's not anticipated to change at any point in time. So it's roughly 10% higher wages nationwide than what we see here in the Tampa market. The good news is our reserve for rainy days are pretty strong here in the state. So this kind of color codes the states that have the highest supply of unemployment benefits. So there are some relatively large states like Texas, California, New York that are on the very low end of that curve. Where in the Tampa and market, Florida in general, we've got a year to year and a half worth of reserves in there for unemployment benefits. So that should help, at least keep some of the local economic numbers a little bit higher. What we have seen, though, is the unemployment claims, and we really haven't gotten great detail at the state level, so it really lags. So we're, kind of 3 weeks behind on the state level. What we do know is they just announced initial unemployment claims this morning, and they jumped by 70,000. So we went from 210 or 211 to 281. So it's about a 33% jump in initial unemployment claims. In the state of Florida, At the bottom of the announcement, it did have a couple of the key states listed. In Florida, our weekly unemployment claims went up by 472. So that's a pretty low number. And we're still in the early days of this. I was shocked when I read through the footnotes. New York unemployment claims actually went down by over 17,000. And I'm trying to conceptualize how that can happen, other than they were a little bit more at ground zero as a big urban area in the number of cases in New York. So maybe people lost their jobs earlier, and we didn't see as much of a decline this week. I think the bigger factor is a lot of these state unemployment claims have been overwhelmed by people. We've heard stories of websites crashing, and it's too hard to get onto them. But in Florida, the number was plus 472. We think that's obviously the tip of the iceberg, that the numbers are going to continue to move upward as we move through the rest of this month into the next month or two going forward. So Christine is actually going to run you through our kind of different scenarios. Just to kind of recap, we were at a place that was really strong. The Florida economy is pretty diverse. Obviously, there's a big piece that's still centered in tourism and travel, so that sector is going to be impacted more than any other sector that's out there. So in the short term, we may take a hit that's bigger than the national average just because of the composition of our workforce, but we still have this great flow of people from the northern markets to the southern markets. We don't anticipate that to change. We still have a huge amount of baby boomers that will approach 65 over the next decade that will continue to provide demand. And the job growth was incredibly solid here in the Tampa market. And while it may struggle here during the summer months, we certainly anticipate that late 3, early 4Q kind of recovery that was presented earlier.
Thank you, Tony. So moving on, yes, to some scenarios that we could see play out due to all these, unfortunately, negative headlines coming through. And as Tony mentioned, the wave of us getting the data in real time, I mean, it's really just beginning. Call it the tip of the iceberg, call it the beginning of the wave, but we are just starting to kind of see the effects here in Tampa Bay. As Tony mentioned, we've also been speaking with our 20 of the local builders, and this is a few tidbits of kind of what we've been hearing already. And this is feedback from the second week in March. So sales down 8%, and this is a weighted average from those responses that gave us kind of a quantified number, whether it be 10%, 5%, 20%. So a weighted average of 8% decline in sales, model traffic down 16%, online traffic remains stable. In terms of model closings, one builder has closed models through April 29th, and that's actually statewide. Some other builders are making sales appointments, only model tours and sales appointments only by appointment, and then some do remain open to the general public. Design centers are staggering appointments to follow the CDC regulations, but in many instances, the buyers are actually canceling on the design centers, whether they be they're adhering to kind of a self-quarantine, stay at home, or they are actually a northern resident and they're not making the trip down here to finalize their selection. So we're definitely going to start seeing some lags in production time because of that. No major supply chain issues yet, but it's really planning to hit in the second quarter. 30% of all building products come from China. We've heard ancillary notes about some of those items in the homes being affected, but the real wave of these issues are going to be felt in Q2. What about around the country? Some feedback we have from our regional directors all around the country and the builders they're talking to every day. Well, suspended warranty work for 30 days, where Tony mentioned we're going to hear and see that in Tampa Bay. Sales by appointment only. The hardest hit sectors have been luxury and 55 plus. Both of these are really to be expected. Luxury due to the shattering effects of the stock market drop on everyone's portfolio, about 30% to date. 55 plus for that reason, as well as, they're, as we know now, the most at-risk generation to COVID-19. So those are the hardest hit sectors. And while it's a good thing that Tampa Bay has such a large portion of baby boom buyers in the short term, we're likely going to see some significant slowdown in sales from those buyer groups and some of those communities. Cancellation rates have actually been stable for now, and the slowdown is really ahead of us. Most builders are trying to keep business as usual with land deals, but we do expect that to slow down as well. So what about some other short-term effects that we could see here in Tampa Bay? Well, buyers of custom homes could ask for extensions on their deposits. Don't be surprised if you hear that. I mean, possibly some of the equity they were planning to use to purchase their home has just vanished in the last couple of weeks in the stock market. We could see some sales canceled, jitters over the overall economy. Potentially, some entry-level home buyers could have lost their jobs already. We're going to see sale cancellations. Spec inventory could actually be fire sold if some builders really want to free up some cash on their books. They may just unload some spec inventory. So watch for that. And then finally, we will likely see a little bit of home price depreciation in the short term. Longer term effects. As Robert mentioned earlier, we're definitely going to see housing starts to decline over at least the next quarter, possibly into the third quarter as well. We're going to see land deals fall through or be delayed as builders try to control their cash that they have on hand. And another wider effect is we're going to see slowing household formation. A lot of the leisure and hospitality workers that could potentially have moved out of, whether they were in school or just living with their parents, starting out in their lives, they moved out to their new apartment. If they lose their job, they're moving back in with mom and dad, unfortunately. So household formation could definitely slow. As a result of that, we will probably see apartment Class A occupancies decline, which will then kind of put downward pressure on apartment rents, which would then create some more stronger situation or a stronger question between the buy versus rent. So if apartment rents decline and they're more competitive to an entry-level housing payment. So those are some longer-term effects that we do think are possible here. Really, what can we learn from China? Because China has gone through this, as we all know, about 2 months earlier than we have. So some of the recent statistics that came out Monday this week, retail sales were down 20%. Auto production was down 32%. The news just came out yesterday that all the Detroit car companies agreed to shut down factories in the U.S. to protect their workers. So that's over 100,000 workers affected. And Bloomberg's economists say, based on the activity data, Bloomberg Economics nowcast model shows China's GDP is tracking negative 20% year over year in the first 2 months. So that is, they are seeing a negative 20% GDP decline just from the first 2 months of the effects of basically halting their economy and deploying those extreme shelter methods. What else from China on the building industry side? Well, starts have gone down 44% and sales have declined 35%. So we're expecting to see that. Robert really factored that well into his forecast. So that's something that we can learn and we will see. We're all wondering, how will this affect GDP? GDP is really a roll-up of all the moving parts of the economy. We think at Myers Research that we might be able to squeak out some small growth still in the first quarter, potentially 0.5% for Q1, just given how strong we came into it for the first 2 months of the year. However, we are obviously expecting negative decline in Q2. There are different forecasts being thrown around all the time, but really it's how bad will Q2 be and how will we react to that data. So moving on just to some strategies and conclusions, really what can we do now? I know the news isn't great. And there are just so many unknowns. Will this be a V-shaped recovery, as some are saying, or will this be a U-shaped recovery where we're kind of bumping along the bottom a little bit longer than we expected? Some news this week makes me think it might be more of a U-shaped recovery. But the question is, how long is the bottom of that U? Is it 3 months? Is it 6 months? Is it 12 months? But the good news is, housing is different. It's a different commodity. As Robert and Jennifer mentioned earlier, housing is an essential service, and it's also a delayed purchase. It's not a lost purchase. You're never going to go out and eat that meal at the restaurant again. You're never going to, you know, have that Saturday night you could have met friends for drinks at that bar. But if you were thinking of buying a home, you know, you're just delaying that purchase now, but it's not a purchase that is going away. So that is a really good point for our industry. Some strategies: use this time now to enhance your technology. You probably are already. Look at your online concierge presence. How many different ways can your prospective buyers contact you right now? This is just an example from a builder out of California, but buyers anytime, day or night, can contact them via text, email, chat, or telephone. Are we going to be able to take some design appointments online? Can they be done virtually, just to keep that production, that part of the production cycle moving forward? I know builders are working on that already. And then finally, virtual tours. Make sure you have a virtual tour for all of your models. So while everyone is at home, you know, trying to keep occupied, they can be walking through your model and still, in a sense, visiting your sales center, visiting your different floor plans, and also visiting your amenity center. So as many ways as you can convert the home buying experience to a virtual experience, the better. Take a long-term view on land, really. You know, this is not going to last forever. Robert did a great job of explaining that and kind of the overall view right now. This is a shock to our economy. It's a shock to everyone, but it will not last forever, and you certainly don't want to miss the boat. This is actually a quote from one of my colleagues here at Myers Research, and I think he put it very, very well, saying a slowdown in starts and closings could make it tempting to slow down your land acquisitions. It is important to differentiate between short-term volatility and longer-term growth trends. Maintaining a lot pipeline is critical. When conditions stabilize, demand will return, and builders need to be in a position to capitalize on that demand and not be in catch-up mode trying to tie up more lots and land. So very, very wise words there. And as Tony mentioned before, we came into this in a very, very strong position here in Tampa. And overall, builders are generally in good shape. It's completely different than the last time. You know, many public and private builders have employed the land banking strategy. They don't have as many lots on their books right now. And in terms of overall debt to EBITDA ratio, the real estate industry is actually one of the few industries that has less debt now than they did in prior economic cycles. So this chart's a little bit dated. It only goes through 2017, but it really does show how builders have been cognizant of the debt that they do have, and they're much better capitalized now than they were during the Great Recession. So in conclusion, Tony made some great points just about how well Tampa was positioned going into this, but the news will be pretty dire going forward. Really, where do we go from here? We're doing our best just to, you know, keep on top of the news and the moving pieces. I think it's best just to stay calm, and we're working with our clients to provide the best possible advice we can at this time. So thank you all for your attention. And Jennifer, I will turn it back over to you.
Thank you so much. I really appreciate Tony, Robert, and Christine. You've all done a great job of providing our members some certainty in uncertain times. Very much appreciated. Just as a matter of reiteration, there are no local level of service interruptions at the county level. Inspections and permitting are still being processed, and the use of technology is providing the ability to continue to do so. There are some silver linings that I do want to remind our members about. One of them is that we're learning this new technology, and we expect to be able to use it moving forward. So that gives me hope that if I can do it, then local governments will be able to do it, and we will see the development process, approval process moving forward within the next week or so. And to answer the question about how does this look with Hillsborough County's moratorium situation, it's really too early to tell. It will be interesting to see how this situation plays into our local government elected officials' psyche and our community. And the last thing I will mention is, you know, all of those workers in the hospitality and the retail industries, they are some very talented people. So trades, go grab them when you can, because we have a lot to offer them as far as careers and constructions go. So thank you again for your time, and be sure to check our website for information updates, tbba.net. That's where you'll see all the new processes for permitting inspections and lots of other information as well. Thank you so much. Take care, guys.